So our next market spotlight will consider a Northern European market of the Benelux. And I'm pleased to invite Mark from the NVP, the Dutch Private Equity Association, to take the reins for this session.
Thank you very much all for coming. You just heard some beautiful talks about Italy. In Italy, the food is good and the weather is always good. But in Amsterdam and the Benelux, we have a lot of rain, so it's also very tempting to come to the Benelux. My name is Mark van Voorst. I'm the Deputy Managing Director of the Dutch Private Equity and Venture Capital Association. We have 115 members, and we mainly represent them in the media, but also in politics. And I have some very interesting panel members here with me today. From left to right, guys, I would like to ask you to introduce yourselves and maybe inform us about your last deals, but also about why you invest in the Benelux and what the opportunities are for investing in the Benelux.
Okay, my name is Cedric Olbrechts. I'm one of the founding partners of Vendis Capital. We are a specialist fund investing in consumer goods scale-ups. And we started in Belgium, actually, in Benelux, where we still do more than 50% of our deals. And we extended in Germany, the Nordics, as well as France.
Rehan Davis, I am one of the co-founders of FreshStream. We started out about 7 years ago, initially as Bregal FreshStream, where our initial investor was Bregal, the Brenninkmeijer family. Now in our second fund, it's independent. We're UK Benelux, about half-half, controlled buyout. First fund was 600 million, current fund we are still raising, so we will see.
Hi. Wolfgang de Limburg. I'm a managing partner of Aragon Capital. We are a pan-European lower mid-market fund, which is active in multiple European countries. We started off in Belgium and Italy. Then we expanded in Spain, France, and Germany. Today we also have an office in Amsterdam. We're managing more or less 2.5 billion of assets. We are investing in our fifth fund, which is an 800 million fund. And we do buyout deals across the different geographies.
Hi everyone, Thomas Villeneuve. I'm a partner with Apax. I joined Apax 21 years ago. I'm in charge of the tech and telecom investments. So Apax is 5 billion euros AUM. We invest in three main geographies, Italy, France, and the Benelux. Benelux for us is a very important region. We deployed 1.2 billion in equity over the last 4 years in a few deals. Mostly in tech and telecom. It's almost 1 billion in tech and telecom over the past 4 years. Latest transactions are Odin, MSP provider in the Netherlands, FEC, CRM software in Belgium, Destiny, telecom cloud provider in Belgium too, Mental Better, healthcare in the Netherlands, and I forget one, Experio, connectivity provider in Amsterdam. So great. And why did we go there? First, it's close. It's not that far from France. Second, we thought that being a non-UK, US-based player was an advantage there, a way to differentiate ourselves. Third, we like to be very active in the participation in which we invest, and the relationship between management and shareholders in the Netherlands and Belgium is great. Very easy to work with people and so on, so that's great for us. The ecosystem is very well developed, so legal, financials, you have everything you need. And for a fund of our size, our last fund is 1.6 billion, plus co-investment vehicle, we have to invest 2 billion. We have the right size of company, and they are already international. So for us, it's a very, very nice playing ground.
And maybe for the others, why are you investing in the Benelux, and what do you think are the best opportunities of investing in the Benelux?
I share a lot of the comments of my neighbor here. I think this is an attractive area. This is a small market, but this is a market with typically quite developed companies. So there are strong business models. Management typically is extremely international, speaks many languages, and the strategy we have is a strategy whereby we help companies develop from one market to foreign markets, and therefore having a management team which is international and which plays well across boundaries is quite important. A second thing which we really like in the Benelux is there are still a lot of primary deals, so deals which are owned by founders or families, and we typically like to be the first institutional capital in companies and try to help them professionalize, structure, and grow. And so there are many of those companies in the Benelux. So overall, we think it is a very nice place to be playing from, and we have so far only done very good deals in the region, so no reason to change.
Thank you. And Cedric, for you?
Yeah, no, very similar to Wolfgang actually, but very talented entrepreneurs, primary deals. There are much less secondary deals in the Benelux, I believe, and we see a lot of a little bit like you see the Mittelstand in Germany, but we see a lot of good Dutch or Flemish companies that are first generation and that we can help to grow to the next stage of development, which is often international, where they are very strong, and also in our case extension of new category of products or extension of channel of distribution.
Yeah, thank you very much. And Rayan, you started in London and you moved to Amsterdam with one of your offices. Was the large LP base one of the reasons, maybe?
A few things. It was our first LP was indeed a Dutch LP, but just by nationality, by background, a lot of us are Dutch speaking, including myself. So that's honestly a big part of it is where your network exists. If you have a pre-existing network, you should try and exploit that. But the two markets are different. You've got the Dutch market, I think, is more commoditized. There's more private equity capital. I think that the Belgian market is a little bit different. It's probably of the Western European markets, probably the least penetrated by private equity, to the extent that you can still come across entrepreneurs who genuinely haven't considered private equity as an option. That is attractive. I think we all share that, if you can find a primary deal. The Dutch market is more evolved. It is more competitive. I think that the financing markets are slightly different, probably a little bit less sophisticated actually than the UK, certainly. And for us, part of the opportunity is, especially post-Brexit, there is an internationalization opportunity. If you can be present in one or two markets, you can try and access either continental European pools and then bring them over to the UK, or vice versa. That is of particular attraction, believe it or not, to entrepreneurs who sometimes worry about the Brexit wall, if you like.
And Thomas, how is investing in the Benelux different from, for example, France or Germany?
The most different thing was probably with the management. France is a very tough market for management package, for example. Was not the case. I hope it was still like this. In the Netherlands, much more easy to really find that. When we started to go there, it was less competitive for us because our differentiation standpoints, like being sector focused, or was easier to, I would say, put forward. And to be honest, I never experienced great difference compared to the French market. You have detailed things on legal and so on, but to be honest, I never felt it was that difficult to go there. Of course, you have to learn, you have to discover, you have to take into account the differences in the management style and stuff and so on. But at the end of the day, Amsterdam is closer from Paris than Marseille or here. It's easier for me to go to Amsterdam than to come here, almost.
Okay, thank you very much. And Wolfgang, how's it different from Germany, for example?
It is different. I think Benelux is a much smaller market than Germany, so that's one difference. I think they are very similar points. So, as Cedric said, the Mittelstand in Germany is quite similar to what you can find in Flanders, in Belgium, and in Holland. So that is a very similar point. For that type of deals, Benelux and Germany are quite similar. I believe there may be more competition in Germany than what you would certainly find in Belgium, and maybe a bit more competition in Germany than what you would see in Holland. Otherwise, these are quite similar markets. I would think that Benelux managers export themselves sometimes better than German managers. But in the different markets that we are active in, I think Benelux and Germany are probably the two markets which are closest together than any other market. So this is quite similar in that respect.
Okay, thank you very much. I have a question for Rayan and Thomas. You see that the world is changing quite a bit. We have inflation, rising interest rates, the invasion in Ukraine, and today actually Putin announced a partial mobilization, rising energy prices, war for talent, and as they say in Game of Thrones, winter is coming. So do you recognize these headwinds? How is it impacting Benelux markets? and how do you weather those macro headwinds?
Yeah, we recognize them. We've heard about them. Look, I don't think there's anything unique about the Benelux per se versus other markets. I think inflation, consumer confidence, all those issues are prevalent throughout Western Europe. I think, how do you mitigate? How do you deal with it? You've got to separate your existing investments from the future. Existing investments, inevitably, some of them are going to be knocked, right? And what can you do to actively mitigate that? There are simple things. You can try and hedge fuel prices. You can hedge interest rates. You can try and delever where you can. You can rein in your spending. You can cut costs. I think everybody will be doing that. I think where the opportunity exists, I think it's actually a very interesting market to be in. So everyone will know asset valuations being going up and up and up. I think the recent rise in interest rates has put a brake on that, and where you feel that where you really do feel it is in the financing markets, where what used to be a 6.5% loan is now moving up to a 10% loan, and all of a sudden it starts to feel a little bit uncomfortable. And that brings down leverage levels. Banks themselves are pulling back. I think they're very cautious, and with leverage coming down, interest rates going up, either you get no leverage at all, or you want to take less because of the interest burden. And with that, I think valuations come down, and honestly, as a time to invest as a result, it does feel like the coming years, with both the combination of distress and declining valuation levels, it's actually pretty good. So you've got to split the two. You've got to be cautious about what you've got in the ground, but it's actually a pretty good time, I think, for the next few years to be investing.
Thank you very much. Thomas?
No, I think nothing specific about Benelux, Belgium or Netherlands. Maybe on the inflation, salary costs in Belgium sometimes is directly linked to inflation for some people. So it's something you have to take into account in your projections. I would say that most of the pressure on recruiting, hiring, keeping people were existing before, especially in the tech sector. It's not new in a way. So companies have been already putting in place some schemes and stuff to face it. If I have to, I agree on what Ryan said, so I won't comment on that. The only thing I would add is, for the first time, I felt, especially in the Netherlands, social pressure, which is quite new for me. I'm still married to a Dutch woman for more than 20 years. And that's the first time I feel that. I go very often there, I have a house there, and I'm a little bit a foreigner too, so maybe I have a way. And it's the first time I felt that pressure. So we have to take it into account in the way we manage companies, I think.
Could you elaborate a little bit on that? What kind of social pressure do you feel?
It's political things. France is, we're quite specialist on that, so I know how to recognize it, and that's a little bit what I feel. It's the first time I give a feeling. It's the first time I feel, we have to be careful on that one. The rest, inflation, the rates, we made a calculation on our portfolio. 100 basis points is roughly 5% additional pressure on our free cash flows, so it's manageable. I started 20 years ago. Normal rates was 250 to 75. So nothing new, and real inflation rate are still below zero. So it's manageable. Russia, Ukraine, we have no exposure. A few developers here and there, but you deal with it. Energy consumption, of course, you were engaged already in a sustainability strategy, so energy consumption is something we were already looking at. It's even more urgent now. And pricing strategies, we know that one of the best value creation levers in many portfolio companies is pricing. People are very good at reducing costs. Sometimes they're less good at rising pricing. And so that's why we are working on systematically in all our portfolio companies now for a few years already.
Okay, thank you very much. I'm interested by your answer about politics. We're going a little bit deeper in it later, I think.
So I know where you're going, so I'm prepared.
I'm getting back to that. Cedric and Wolfgang, how are the macro headwinds in the Benelux affecting the deal flow and the fundraising?
Yeah, I can start on the deal flow. Well, first of all, sellers' expectation will have to adapt, right? There is a crisis, and you see it's not there yet. Yeah, so that will take a bit of time. I think that's our view. But then we focus mainly on proprietary deal flow, primary approach, proactive approach, and you have plenty of companies that with founders that are looking to find a backer at some stage, whether it's now or it is in 1 year, doesn't matter. It depends on the value that you can bring to the table, and so that's what we're doing now. Just back to the basics, just pitching entrepreneurs and doing proactive work, especially in the Benelux. That's on the deal flow. I can do on fundraising later.
On deal flow, I'm pretty much in line with Cedric. So what we have seen is definitely a slowdown of activity. So I think auctions are reduced massively. So there is much less activity than in the past. As Cedric said, we are as well very active in primary deals with founders, and so those deals still occur. And even to some extent, founders that have surfed a wave, a very positive one for the last 10 years, they were not really sellers, they were picky. Today that they see that, there are storms coming, some of them may decide to press the button and decide to actually want to speak about selling. So we see some situations which we've been farming or teasing people for many years, and now they become more open to a dialogue. And what is quite frustrating is that some of these companies, we've done so much work for so many years to try to get them through the line, and now that they come, we sometimes are a bit lukewarm because we think that this company may suffer. So basically, I think there is going to be less activity. That doesn't mean that there will be no deals, and price will need to adapt to interest rate and returns expectations. So that's what I would say in terms of deals. And in terms of fundraising, which was part of your question, we are luckily out of fundraising. So we finished last year in December, which I think was a good idea. What I hear from placing agents is that they compare this period to the worst times of 2009. So I think fundraising is difficult. At the same time, I think that, like for deal making, many people are pausing. So they put pens down. They look at what they have, what issues they could face. Some people have an issue with allocation and may need to pass a bit of time. But the amount of equity which is there is huge. And so I don't see a reason why fundraising should stop. So I definitely think it's going to be more difficult in the year to come than in the last 3 years. But in my view, good funds and good strategies will keep fundraising. This asset class has always been performing better than the public market, so this should not stop. But obviously, I think at this specific point in time, the markets are a bit depressed in terms of fundraising, from what I hear.
Okay, thank you very much.
Yeah, and I can add to that specifically on the Benelux. There are quite a lot of family offices that are looking to invest and deploy in private equity. That has been the case for a long time. Actually, a lot of families are doing themselves a lot of direct investments, and you see a lot of others moving to private equity in general. And so I think that will compensate quite a bit the lack of activity maybe by institutionals in the Benelux.
So Edric, you're actually touching on some opportunities of those macro headwinds. What other opportunities do you see in the times we're approaching?
Typically what you see, I mean, it's going to be a bit specific to what we do, but we see a lot of opportunities to look through in the consumer goods world of good companies that have big area for growth, being an international strategy, being a category expansion, a channel extension. And indeed, a lot of people say, yeah, you know what, consumer goods, it's a dangerous market, inflation, blah, blah, blah. But there are plenty of pockets of growth in there. And for us, it's actually a very good time to invest and pick up those good companies based on our expertise in consumer goods.
Rayhan, do you have some thoughts to add to that?
Yeah, I mean, the opportunities are much more on the investing side, obviously, than on the existing portfolio. And if you had to try and be concrete about it, there are probably a couple of things. First, rising interest rates. Now, there are a lot of companies out there with a lot of debt. Not everyone has been putting hedging on. I remember back in 2008, it was standard practice that when you get your debt, you would lock in 2/3 fixed and the rest of it. That's kind of fallen away from the market. And there are, I think, a lot of companies out there with unhedged debt and high debt loads. So what do you do about that? Where's the opportunity? Well, some of those companies may struggle. Not operationally, and from a macro perspective, they might be good companies. They're just over-levered. And so I think there will be a chance to put capital to work trying to take some of those companies out of those problems. So that I think is one. In terms of other opportunities, I think what we are seeing, and it's the point you alluded to as well, is that founders who previously either were very bullish and therefore didn't want to sell, or if they did sell, when market multiples are high, they'll sell the whole thing. Why would you not, right? The market taken a hit, and I think a lot of entrepreneurs have taken a hit to their confidence, not necessarily their businesses, but they worry. And when they worry, they're more prone to sell. And when they sell, they maybe don't want to sell the whole thing. And when that happens, the dynamic of buyer and seller changes. And instead of buying 100% where the seller's motivation is price, just sell at the highest price, it moves. It moves. So actually, maybe I don't want to sell the whole thing. Maybe I want to sell 60%, 50%, something like that. And the price discussion changes and the dynamics change. So I think outside of just the raw fact that high interest rates should bring the valuations down, there are specificities in the market which I think will make a difference. I think there's a lot of opportunity in the coming years, in the sort of 1 or 2 year window.
Okay, and touching on the opportunities, if we look at the financial crisis at the GFC, we saw that private equity-backed companies actually did better than public markets. And you might say that it's the same happened in the corona crisis. And I was wondering, with the macro headwinds coming, do you think the sector is better equipped to deal with those situations than public markets? And it's maybe a question to all, but also to Rayan.
It's very different, this crisis. So in the Lehman's crisis, indeed, there was a financial distress, but interest rates stayed low, right? And so there was not the issue of over-leverage coupled with high interest rates. This time, it is different. If interest rates are high and keep rising, coupled with an economic downturn, then you have not just a squeeze on earnings, you have the pressure of your debt as well. It does feel different. Last time, what happened is that the low interest rates and government intervention just kept everything on an even keel. Government balance sheets are not as strong this time. Interest rates are moving up, inflation is moving up, and there's pressure across the cost structure. So I think, if I had to guess, I'd say this downturn is going to be tougher than the last and probably longer duration, but we'll see. Yeah.
I think it's very simple. Either you can predict, or you're ready to act. I think over the last 20 years I'm doing this job, I've never been able to predict most of the crises. Nobody has seen them. You have signals and so on. So you have to be able to act. And I think the strength of the privately owned companies is the governance. And the governance help you to act quickly and to be agile, reacting to any crisis. So I think it's very simple. We have to go back to the basics. What makes the attractiveness of private equity is the governance. You have all the things and so on, but that's the governance compared to listed companies. And I can tell you, sitting also at the board of listed companies, compliance, regulatory, and so on, put a lot of burden. And so we privately owned companies compared to those ones are more and more agile. And I think that's, at the end of the day, if I stay back, I think that's the most important factor.
Wolfgang, do you have anything to add to that?
Don't have much to add. I think Rayan said it all. And in my view, what he said is quite true. So in my view, the crisis is extremely different. We have inflation, which we didn't have. We have very high interest rates. And I see, where I keep the same opinions last time is, private equity companies, they're agile, they're out of the public eye, they don't need to deliver each quarter. So that's a very good point, and that helps company make the right decision for the long term instead of managing for earnings. But this time you have very high leverage and interest rate going up. So you will have companies facing inflation of salaries, inflation of energy costs, so squeeze in margins. You may have a decrease of economic activity, which may render the pass-through of price increases more difficult. So you're going to have a further squeeze on margin, and on top of that, you're going to have high debt load and rising interest rates. So I think some private equity companies may run into trouble, which is a very different situation than what we've seen in the GFC. So that would be my worry. I think private equity may fare a bit less nicely in this crisis than in the previous crisis versus public companies.
Okay, I think we have a few more minutes left, so 2 more questions. Wolfgang and Thomas, we see a political debate in the Netherlands about carried interest in private equity in healthcare and daycare. What's your take on this, and how do you deal with these kind of situations?
Maybe you take the carry, I take the healthcare.
We make no carry, so I have nothing to say.
So I'm not.
What is carry?
I'm French, and so it's not there. So on the healthcare, it's very simple. There is a motto which is never complain, never explain. I think our industry is never complain, better explain, because we can't complain. It's normal that political regulators look at what we're doing. The industry has taken such an importance into the industrial landscape and so on that this is normal in a way. The manner is, you can always discuss the manner, okay, but that's normal. So we have to be ready to explain why we are legitimate and why what we're doing is bringing better things for the community and so on. And if you take in the healthcare system, we consolidate, we process, we industrialize. And I think at the end of the day, the service we provide is better. And there is only one judge. It's we recruit the practitioners, they come in, they want to work for those companies, so you're not that bad. Clients are there. Insurance are providing us better tariffs than some others. So at the end of the day, I think we're doing a good job. Misunderstanding, fine, but yeah, then you have to explain. Today, it's part of the game. We have to explain what we're doing.
Yeah. And we were very impressed in the Netherlands by how you dealt with the situation and communicated actively with all the stakeholders involved, politicians, civil servants. So that's very serves as an example.
But here again, we have to be ready for this because it's normal.
Okay, let's go to the last question. If you could all give one piece of advice to the people in the room who wants to invest in the Netherlands or Luxembourg or Belgium, which one would it be? Maybe from left to right?
Don't come. We want to be still making a lot of deals there.
There's a piece of advice which is not linked at all to the geography, but I think at this moment in time, people need to be extremely careful as to what they pay for companies and what companies they buy. So everybody should try not to be the last fool buying a company at a very high multiple on the eve of a recession. And so be extremely picky, don't overpay, and because I think the times ahead will be more difficult. So this is the moment to be extremely disciplined, in my view.
Well, we're fundraising, so commit to our fund. It's quite easy. Look, I think if there's one piece of advice is don't get fear. Fear often drives bad behavior. I think it's right to be skeptical, it's right to be cautious, but I also think there is opportunity. And I think the next few years are going to be pretty interesting.
I don't think I need to give a piece of advice to this intelligent crowd, but you know, just I think it's going to be very important to have a very specific strategy on what you want to do, and indeed keeping discipline to it, and then indeed be a good shareholder. Just develop the company as it is. Yeah.
Okay. When I opened my FT app this morning, I saw that the FT was present yesterday. Wrote an article about the panels. So I hope they're in the room right now and going to write an awesome piece about investing in the Benelux. I would like to thank all the panel members for joining us. I would like to thank you for listening, and I wish you a great day.